The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. Welcome, everybody, to this week's episode of the Fed15 podcast, presented by Serving Those Who Serve. Each week, we'll discuss the latest news and info that feds need to know in 15 minutes-ish or less. So whether you are a seasoned federal employee or just starting out in your career, Fed15 has got you covered. So grab your coffee, kick back, and we'll tell you what you need to know but might have missed in the federal space this week. We are your hosts as ever. I'm Katelyn Murray, and I am joined by Mr. Dan Sipe himself.
How are you, Katelyn?
Good. Chilly. We are almost officially in winter, and the trees are starting to look a little skeletal, a little less fall, a little more winter. So,
well, we're a little further north, so we've lost a lot of leaves up here. And I'm happy to be back in my normal duds.
For
this.
Sure.
Because again, folks, the whole purpose behind what we do is to get you what you need. Okay. And, when something comes up like the shutdown, then we've got to pivot to make sure we get you what you need there. You could see it when we opened up the early retirement webinars, and created those and got them going. And we're always going to do that. But I would much rather have what we do be about advancing you, prospering you, rather than how do we minimize the damage. And,
rather than damage control. Yeah,
exactly.
Sure.
Exactly. So glad to be back in my normal togs. Now I may, it is entirely possible that I might be breaking out some holiday attire coming episodes, but we'll see how that turns out.
Dan does love his Christmas garb.
Yes, he do.
Holiday guy. Awesome. Well, so we are going to be kind of interestingly talking about a really interesting piece that was on the website this week about different proposed shutdown relief, credit protection, and options there. So I think it's interesting to kind of highlight a couple of bills that are kind of in the works right now related to that topic. And then we're going to talk about TSP. We love talking about TSP. Finally, so everybody else's Christmas happens on December 25th, right? My Christmas happens late October, early November, and I was eagerly awaiting with bated breath the IRS's updated contribution limits for the TSP and other retirement vehicles. They finally came, folks. I've been fussing for weeks because I didn't have them. Finally, they have arrived. So I'm going to go over that with you a little bit later in the episode so that you have your TSP game plan together before January and you can get that in place. But before we get to that, Dan, talk to us about some of these resources,
Sure.
Proposed resources for feds in shutdown situations.
Gotcha. Well, I want to start by saying that I'm of two minds about this. Number one, I'm all for anything and everything that protects our feds when things go off the rails, and shutdowns, in my opinion, are going off the rails. So that part's good. The other part, the just little stinging thing in the back of my brain is, if you're putting these things in place, are you basically saying, hey, we realize we're just going to keep doing this? And if you've watched this, if you listen to this, my take is this was never meant to be a lever of government. So the good news is that the folks on the Hill have recognized that shutdowns create cash flow issues for feds and contractors. So they've got some new proposals aiming to protect credit, expand penalty access to funds, and create clearer guidance with the long-term goal to reduce financial damage related to funding lapses. So bill number one, HR 5689, Shutdown Guidance for Financial Institution Acts. The core purpose is to protect borrowers from credit harm and push lenders to offer temporary relief. But what the bill directs regulators to do, for example, the Fed, the CFPB, the NCUA, is to issue shutdown-specific guidance to lenders, encourage banks and credit unions to modify loans, extend credit, and delay payments, ensure borrowers aren't hit by negative credit reporting caused by the shutdown, and to publicize guidance quickly so lenders and borrowers understand the available relief. And I think we can all agree those are all going to be good things. So I'll press on here. Bill number 2, Emergency Relief for Federal Contractors Act, HR 5690. A lot of times this gets lost in the noise. Federal contractors aren't getting paid during a shutdown either, and there's no back pay. So the core purpose is to provide contractors with penalty-free access to their retirement funds during the shutdown. The key provisions would allow contractors to draw up to $30,000 from retirement accounts penalty-free and give the option to repay within 3 years or report the income evenly over 3 years. And it's designed to help cover missed paychecks without permanently draining retirement savings. Practical impact there, I think we can all see it. It creates a contractor equivalent to a TSP penalty waiver. Next up is the Emergency Relief of Federal Workers Act, 2025. Its core purpose to build automatic shutdown protections into the TSP system for federal employees. So now we're on the other side of this. Penalty-free early TSP withdrawals during shutdowns and the ability to recontribute the funds later. Continue access to TSP loans, and automatic pause on loan repayments without there being a taxable distribution. So again, creates built-in predictable TSP relief for every future funding lapse. And I hate the fact that there could be more. So in the interim, what should we be doing while Congress deliberates? Document any shutdown-related credit, payment, or income issues. That's useful if lender rules change under HR 5689. And for contractors, model potential cash needs with the $30,000 proposed limit in mind. Feds, review the current TSP hardship withdrawal rules. Avoid irreversible moves in case new release options become available. And as always, and we've talked about this for weeks, talk to HR, talk to your lenders. Okay. Many already offer hardships and forbearance programs without even having the new laws. And again, stay aware. These proposals, they aim to help, but the rules may shift. Bookmark our page. We're going to be pushing it out there. So, Katelyn, tell us about Katelyn's early Christmas.
So I wrote the article on the blog about this. And the first line of the article is, it's the most wonderful time of the year. And it truly is for me, because one thing that I like is saving money towards retirement and helping feds do the same thing. And now we can save more, which is so exciting. Okay. So we have some updated contribution limits for several key retirement accounts. And I want to make sure that we kind of go through these together and that you have a plan in place to make sure that you're maxing your TSP, because here's the big takeaway, okay? If you were set up to max in 2025, you no longer are set up to max in 2026. The ceiling has been raised and you need to change your contribution as a result. If you don't change your contribution, you won't be maxing anymore. They don't automatically change your contributions, okay? So with that said, you've probably seen some communication from the TSP about that, but if you're like everybody else in the middle of the busy holiday season, you may have deleted that email. Don't delete this podcast, okay? So let's walk through it together, all right? So for where the TSP is concerned, all right, the standard contribution limit in 2025, so this is my folks who are under 50 years old, and my folks who are over 50, but everybody, regardless of your age, in 2025, you could put $23,500 into your TSP as a standard contribution. In 2026, you can now put $24,500 into your TSP as a standard contribution. So that has been increased by $1,000. And that standard contribution, no matter your age, no matter your income level, can go into your TSP as traditional pre-tax contributions, Roth contributions, or some combination of the two, okay? Now, catch-up contributions, all right? So this is my folks who are 50 and older, okay? And I'm going to carve out a caveat for those of you who are kind of in the middle there, but we'll talk about that in a second. So if you're 50 and older, right, there is a higher catch-up contribution for you. In 2025, this was $7,500. In 2026, this has been increased by $500 to $8,000. So if you were over 50 or older is what I should say, in 2025, the maximum you could put in your TSP was $31,000. Okay. In 2026, you can put in $32,500. Okay. Now, here's a caveat, and this is important. I encourage hitting the website and actually looking at this article, especially if you're a visual person like me. If your income is over $145,000, and this isn't a separate single and a separate married, okay? This is you as a individual. If you are making more than $145,000, okay, in wages, that $8,000 catch-up contribution starting next year has got to go into the Roth option. You don't have a choice. It can't go in as pre-tax. If you have been maxing your TSP to the pre-tax traditional option, this means that your taxes are going to look different in 2026 than they did in 2025. Because of Secure Act 2.0, you've got to put those catch-up contributions in as Roth. Now, your standard contribution can go in as pre-tax. Okay, that $24,500 can go in as pre-tax. But the catch-up contribution, that other $8,000 for 50 and up, that's got to go into the Roth option. Okay?
Gotcha.
Here's where, again, go to the website, read the article. It breaks it down for you. If it's not making sense going in this way, look at it, and hopefully it will make sense. If it still doesn't make sense, email us at askstws@stwserve.com. All right? So now that we're clear on that, let me make it even more complicated. So also because of Secure Act 2.0, we have a little carve out. So I said that everybody who's 50 and up can put an additional $8,000 into their TSP, okay, as catch-up contributions. Well, if you are 60, 61, 62, or 63, only those ages, 60, 61, 62, or 63, those 4 years. And this is your age as of 2026. So you could be 59 in 2025, turning 60 next year. This would apply to you. Instead of, not in addition to, instead of that regular catch-up contribution of $8,000, you can put in a super catch-up contribution of $11,250. Okay? And you can do it for the years that you're 60, 61, 62, 63. So if you're listening to this podcast and you turn 63 in 2025, I'm so sorry. I'm so sorry. You're going to be 64 in 2026, which means you can only put in $8,000. Why does it bump up only for those 4 years and then go back down? I don't know. You'd have to ask the Secure Act 2.0 legislators who didn't have a financial planner at the table when they were drafting that piece of legislation. And Dan and I both volunteered. So the way that this works, if you will be between 60 and 63 in 2026, you can put in that standard contribution of $24,500. It can go in as pre-tax, it can go in as Roth, it can go in as 50-50, 20-80, however you want to do it, okay? You can then put in the super catch-up contribution of $11,250, okay? If you make over $145,000 in wages, just you, not between you and your spouse, if you make over $145,000, that $11,250 super catch-up contribution has got to go in to the Roth portion of your TSP. This has got implications for your tax situation. It's also got implications for your take-home pay, because when you contribute to Roth, your paycheck is a little bit smaller. It takes a bigger bite out, okay? So definitely recommend going and taking a look at the article on the website, because it really breaks all that down in what I hope is a very clear way, okay? So we got a couple other changes as well. IRA and Roth IRA contribution limits have changed. They've been increased, which is great. In 2025, you could sock away $7,000 as a standard contribution to an IRA or a Roth IRA. Now that standard contribution is $7,500. Okay. There is a catch-up contribution associated with IRAs and Roth IRAs. If you're 50 or over, you used to be able to put in an extra $1,000. Now you can put in an extra $1,100. So for 2026, if you are under 50, your contribution, your cap on what you can contribute to IRA and Roth IRA is $7,500. If you are 50 or over, you can put away $8,600 in those accounts. Okay. So a little bit more savings ability there. Simple IRAs, we won't spend a ton of time on this, but I do know some folks out there have simple IRAs, particularly my contractors who have self-employment income. Those contributions have also been updated. The standard contribution for everybody under 50 has gone from $16,500 up to $17,000. And if you're 50 or older, you can put in an additional $4,000. So the total that you can put in if you're under 50 is $17,000 on a simple IRA, 50 or over, $21,000. Okay. Now, what this means for you is there are some more tax deferred growth, right? Because those standard contributions have been increased and you can put that into the pre-tax option. If you have been maxing to pre-tax, it means your taxes are going to look different in 2026 and you got to figure out a plan for that. Okay.
Gotcha.
It means that there is increased agency matching. If you are increasing your contributions early in the year, that could be a factor there. And then you've got more stability in your long-term retirement plan as inflation costs rise. The whole reason that the IRS increases these limits every year is not to make me happy. Trust me, they don't make legislation to make me happy. What it is making sure that you can keep up with inflation. Okay, so as things are getting more extensive, they are also allowing you to defer more of your income into those retirement accounts. Okay, so what's the action step here for you? Make sure that you recalculate your TSP contributions. All right, and I'm not going to break it down on the podcast, but I have broken down for you if you're under 50 and you need to hit that $24,500 standard limit over 26 pay periods. I've got exactly what the contribution needs to be. If you're 50 and older, but you're not in that bracket of 60 and 63, and you need to max out with the catch-up, I've got exactly what the contribution needs to be. And lastly, if you're in my group of chosen few who are going to be 60, 61, 62, or 63 within the 2026 calendar year, I have broken down what your contribution needs to be per pay period to hit that max. So please hit the website, check out this article. Please take advantage. I know you're probably listening to this wondering why I'm so excited about a $1,500 contribution increase in the TSP. It's because I know what $1,500 looks like with 10 years of growth, 20 years of growth, 30 years of growth. Okay. So that's why I'm excited. It does matter. Make sure that you're shoring up those contributions and that you are making or taking full advantage of the options that are available for you to build your financial future.
Absolutely. And don't let the Grinch steal your financial future when Katelyn just brought you a great Christmas.
Yeah.
So
I'm Cindy Lou Who over here.
who is not more than two. So
I know. Have a great skincare regimen.
Indeed. Well, I think that's all the time we have for today, folks. But have no fear. We will be back next week to bring you the latest information updates you need to make informed decisions about your career and financial well-being as a Fed.
And to make sure that you are there for next week's episode, make sure that you're subscribed. There's a bunch of folks who are watching our videos on a regular basis who aren't subscribed. Please do subscribe on YouTube, on Spotify. You may not look at your notifications. I pretty much never do. But by subscribing, you are telling YouTube, you are telling Spotify, hey, this is good content and we want more people to see it. Okay. So by subscribing, even if you don't care about notifications, because I don't, I get it. It helps boost the signal and helps us reach more Feds who maybe don't know that this information is out there and available for free.
Absolutely. And for more information on the topics covered today and way more, check out our blog on the website. That is swserve.com. You'll see the blog section. Click on it. It's all there. Scroll your way through it. Spend the day there. There's plenty of great stuff. And subscribe to our newsletter, The Weekly Serving, to get all the latest news for Feds delivered straight to your inbox every single week. You don't even have to go looking for it.
For sure. I know you got a lot of holiday gatherings coming up. All right. I'm not telling you to ignore your family, but if you need a little escape, our website is a very productive escape. For those who want to dive even deeper into learning about your federal benefits and financial planning for Feds, we encourage you to join us for one of our complimentary webinars. We have some great ones coming up in December. We did not take the month of December off. We are still out here educating you. So if it's a little bit lighter of a month for you around the holidays, if you can carve out the time, spend that time with us. I promise I can't promise you it'll pay dividends, but I promise you it'll be worth it. How about that? TSP planning. We've got a session coming up on December 12th from 11 a.m. to 2 p.m. We've got another session coming up on financial planning that's on December 16th from 11 a.m. to 2 p.m. I am hosting both of those. Please stop by, say hi, say Fed15 sent you, and I would love to give you a warm welcome. If you do prefer a one-on-one approach, maybe you can't carve out the time for a webinar, we totally get it. You guys are busy. Feel free to reach out to our team directly for a financial planning consultation at meetings@stwserve.com. We'd be happy to see how we can help you.
Absolutely. 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 So thanks for listening to Fed15. I'm Dan Sipe.
And I am Katelyn Murray.
And we will see you next week.
See you there.